inflation's often compared year over year.
Hmm.
And so last year, during April, May, and June, inflation by most metrics dipped very low because you had the initial shutdowns, things like that. And so when you're doing a year over year comparison, you can actually get some pretty high numbers because you're comparing to like a bottom of a dip. Whereas
Okay.
if you were comparing to say, February to February, it'd be less extreme because you're comparing to what was already a reasonably strong month. It's kind of before the pandemic, and so we're going to get some pretty high headline CPI numbers. And there's all sorts of issues with CPI. I have charts coming out showing how most prices that we care about have gone up faster than CPI. But even the official CPI numbers are likely to be over 3% during this base effect period, and you could overshoot to 4% or potentially higher. So I'm kind of watching that to see how the bond market responds to that. The topic is going to be the idea that it's transitory, that this is an inflation spike, and because of those base effects, that's partially true. But then if you're a bond holder, you have to how sure are you that they're transitory, or how big is the spike going to get? How persistent is it going to be? What's going to happen with ongoing fiscal stimulus? And so this could be kind of an interesting period for bond market, gold market, Bitcoin market, just kind of see how this plays out. The other thing I'm watching is that as the base effects, the other side of that, as we look into quarter three, that's where some of the euphoria of really good year over year numbers, right? So it's not just inflation that has those base effects; it's also GDP growth and construction spending and retail spending and corporate earnings. They all had a really bad quarter two of last year. That was their worst point, and so their quarter two here is going to be incredible. But then once you get into like quarter three, we pumped a lot of money into the economy. Some economies are not really kind of pumping a lot more. Some of them are even kind of just starting to pull back and normalize. And so some of the euphoria that's propped up, assets ranging from Tesla to Dogecoin to, basically across the board, it's good assets, bad assets, a lot of that's what's propped it up, could start tapering and pose a challenge. And the risk there is that even some good assets can dip and pull back if you get a broad market that kind of isn't being held up by tons of stimulus anymore. And it's one of those things where, because it's a sensitive topic, inflation, there's kind of misleading aspects on both sides, and that's it. So the misleading part about some of those year over year numbers, that Joe was correct about, is that you're comparing that one year where commodities fell into a hole, right? Because China just like stopped buying energy, stopped buying copper. They're the biggest buyers. They were totally shut down, and then you kind of exploded out of that big kind of down part. And so the year over year numbers are ridiculous. But for example, if you back up and you look at commodities over the past 10 to 15 years, most of them actually are not at all-time highs. So lumber is, that's been like it looks like a Bitcoin chart. And then you have gold touched new all-time highs in 2020. It's been in a correction, but it still touched it. Beef is at all-time highs. But for example, the overall, if you take an aggregate of most commodities, it's actually been in like a 10 to 15 year bear market. And just because we had a period of, in the 2000s, you had a period of, China had a fast growth rate. There was a lot of commodity demand. We brought a lot of new commodity supplies online. And then when China slowed down and the whole world kind of adapted to this, we've been in this period of commodity oversupply. And so I think a lot of those year over year numbers, basically a lot of commodities are just getting back up to where they were before. Like oil is just back up to where it was before the pandemic. There's some like copper that are elevated but still not at all-time highs. And then there are some that are at all-time highs like lumber. But then the funny thing is, if you look at timber, right, which is before it becomes lumber, it's timber. That's actually not that expensive at all. It's really about the bottlenecks of turning timber into lumber, right? So the basically the refining that has to go into cutting that up and getting it treated. And so a lot of that is about supply chain issues. Same thing we're having in the semiconductor industry, where there's not enough foundries to make the semiconductors. And so on one hand, kind of focusing on those year over year numbers can be misleading, and can for readers that know what those base effects are, that could even turn them off they think, okay, this people in this industry don't know what they're talking about. On the other hand, people that are saying there's no inflation, especially over these several years, are also misleading because CPI is a really crappy statistic for the most part. And I actually have a chart coming out later today that just shows, housing has gone up faster than a CPI, food has gone up faster than CPI, healthcare has gone up faster than CPI, tuition's gone up faster than CPI. Uh, you know, the cover price of the New Yorker magazine has gone up faster than CPI, a lot faster. And so, basically we've had a couple deflationary areas like consumer electronics or things that you can outsource to China. Those have been, globalization, technology. They've really pushed down the cost for things. Same thing, your cell phone can now do what, 10 of your electronics could do, a decade ago. So that's been the deflationary area. But then pretty much anything you can't outsource or that isn't automated has gone up faster than CPI. And for most household budgets, that's still where they spend most of their money. Housing, education for their kids or themselves, healthcare costs, either through themselves or through their employer, which eats into their compensation total. Those are the areas where we spend most of our money. And so it's one of those things where we actually have had pretty significant inflation over the past, 10, 20 years. But that year over year number is still somewhat misleading for how fast it's been. Some of the things I'm looking at are the producer price index, which is kind of a precursor to inflation. That's been spiking. Just the overall kind of you can look at the bottlenecks in the industry, like we talked about the semiconductors. We talked about lumber. We're seeing that in shipping over the past few months, where just there's only so many containers and container ships, and so we have had various supply chain issues. And so that's how I'm monitoring it, where it's often the case that the truth is in the middle. And that's what I'm finding here with inflation as well, that we are getting an inflationary impulse from this fiscal spending, but it's not like inflation is, is absolutely massive in that 12-month period. In many countries, especially the United States, there's been a movement from cities to suburbs, and this big kind of grab for single family homes that in the U.S. at least, and some other countries are made up a lot of wood, and then there has been a lot of remodeling, and there's a bottleneck in terms of how many sawmills out there are able to turn timber into lumber, and now, there's also a money printing component because, for example, if you didn't have the fiscal stimulus, if you didn't have the stimulus checks, the unemployment benefits, then fewer of these people would have been able to afford it. There would have been more solvency events, and so the prices would not have been able to go up as much as they did.
Okay.
Same thing, I've often pointed out that over this course of this pandemic, personal incomes are up, even though unemployment is down. And that's because we did various aid programs to keep people afloat, and so that allowed them to keep spending and do things like that.